Tom Lee has recently shared a perspective that might turn some heads in the financial world. He's pushing the idea that, despite the recent rate cuts by the Federal Reserve, we're not looking at the crash some investors might be fearing. In fact, he believes the opposite, that the current cut cycle could lead to a stronger market in the long term. Lee's main point is simple: many people are expecting a hard landing, that is, a tough economic slowdown. But he's arguing that the market is in for something different. His take is that the Fed's move to cut rates is setting up a positive environment for growth. And yes, while the 50 basis points cut may not seem huge, it's a signal of the Fed's readiness to step in more aggressively than people might have anticipated. This could be a powerful catalyst for the market. He points out that the impact of a more dovish Fed, one that's more inclined to keep rates low, isn't something we can ignore. It creates a shift where investors need to reevaluate and adapt, which can ultimately boost the market. But here's where things get tricky. In the short term, Lee warns of turbulent times ahead. The stock market, he says, loves certainty. Any ambiguity or waiting game, like election uncertainty, causes the market to spiral. This bipolar behavior could leave us with volatile markets for a bit, but, as Lee notes, it's just temporary. Once the political picture becomes clearer, the market's performance should stabilize, potentially rallying by year-end. So where does he think investors should focus? His advice is clear: cyclical stocks, specifically industrials, financials, and small caps, might be the best options. In uncertain times, these sectors have historically performed well. Industrial and financial sectors often act as safe havens when market uncertainty rises. Small caps are another focus, given they're more sensitive to rate cuts and may benefit from lower costs in sectors like auto loans, credit cards, and mortgages. This focus on cyclicals and small caps highlights Lee's belief that the economy has room for growth without spiraling into inflation. And speaking of inflation, he's not worried. According to Lee, inflation is essentially over. The only factors holding inflation at around 2.5% are slow-moving metrics like shelter and auto insurance, which don't adjust frequently. In other words, inflation's impact is winding down as housing and insurance rates stabilize. With supply chains fully open and oil sitting around $70 a barrel, the inflationary environment just isn't there to justify fears of a resurgence. The big takeaway? Long-term investors shouldn't be overly concerned. The Fed's rate cuts are giving the economy a chance to grow rather than signaling a crash. Lee argues that history backs this up, with past rate cuts typically supporting a market rally. He likens it to a patient given antibiotics early enough to recover. If the rate cuts come when the economy is stable, they can prevent a downturn instead of worsening it. His outlook remains optimistic, seeing a higher chance of growth than a recession. While he acknowledges that short-term volatility is inevitable, the data doesn't support a recessionary outlook. GDP, unemployment, consumer sentiment, and spending levels remain steady. Lee sees nothing recessionary in the current numbers, and with Fed cuts happening sooner rather than later, he believes the economy is on track for recovery. In a final point, Lee emphasizes that, as long-term investors, there's no need to worry about weekly fluctuations. If history is any indication, the market's long-term outlook is positive, with average annual gains for patient investors.